A very good evening, students. Give me 5 minutes so that I can start the session. Just hold on for 5 minutes.
Okay, sir.
All right, students, let's begin the session now. The today's session begins with income from house property. The income from house property, any income, whether it would be rent received, whether it would be received from whether it would be related to any being used for commercial purposes, which has been used on rental basis. So if income arises from your from such property, it becomes taxable. And the SC an individual has to pay tax on such income which has been earned from house property. Let's begin by the example terms which has been used in calculation the income from house. What are the rules and regulations which need to be followed to estimate such income, right? And what are the different perspectives that we need to learn in theoretical aspect, or you can say which has been very important for the examination, whether it to multiple choice questions or whether it related to subjective questions, right? During your final examination. So let's begin the basis of charge. So when it comes to about income from house property, it comes under section 22. So it might be asked for multiple choice questions in which section comes under this category which has been calculated income from house property. So different sections has been given in the option. So you have to come to that correct one. So this is the section 22. So the income is taxable under the head income from house property if the three conditions is satisfied. So these are the three conditions. If these three condition is satisfied, that means such income is taxable from income under the heading or head income from property. So the first point is the property should consist of any buildings and the land appurtenant thereto. Any income which comes from any building, whether it would such building has been used for the residential purposes and such buildings has been used for the commercial purposes. Any income earned from such buildings that is taxable. Now it's come to the lands apportionment. Lands apportionment, it means that it gives a right to an individual who owns a property for making legal transactions. It will relate to any type of land, any compounds, any streets, any or any kind of land which has been used for residential or commercial purposes while making any legal transaction on such land. That is called the land apportionment. Second condition is the SSC should be the owner of the property. Of course, that is very important that if you are occupying any such property, you must be the owner of that property before giving such land or such property to any of the tenants. Third condition is the property should not be used by the owner for the purpose of any business and profession. The property that you own, it should not be used by the owner for the purpose of any business and profession. For example, I'm a chartered accountant and my work is to do and finalizing the income statements, balance sheet of the various varieties or categories of the companies. And I took a property on rent basis. So if we talk about the income that I earn from the such profession, that is not taxable, right? Why? Because such income will be taxable under the head of income from business or profession. Because chartered accountant is my profession. So if it is my profession, so my income would be taxable under the income or profession, right? So if these three conditions is satisfied, that means any income besides these conditions, it is taxable under the head of income from house property. Next, we talk about the properties that consist of any building or land appurtenant. So let's begin of these following points. If the property consists of any building or land thereto, it is chargeable to tax. Build. What are the buildings we include? What is the meaning of that buildings? What is the land appurtenant? What is the income that from any vacant property? Whether such income is taxable or not? The answers is given in this particular slide. Building includes any residential home or house or I'm living there. I or own for any of the purposes, residential or commercial, or any legal transactions. Next point is income from vacant would not be taxed under the head house property. That any income that comes from any vacant land, the land which is not being used yet, would not be taxed under head income from house property, because the reason behind is this, that there is no building, that is a vacant land, blank land available, and it has not been used here. So hence, no income has been earned. So that means it is not taxable. It is either taxable under the income from other or income from business of the right. If it is not tax, if it is taxable, totally depends on the case on
Excuse me, sir.
use.
Excuse me, sir.
Yes, hello.
Hello. You are breaking. I'm unable to get most of the words. You are breaking, sir. I'm
No
unable to
problem.
get most of the words.
Now it is audible.
You are still breaking a bit.
Now it is audible. Speaking.
You are still breaking, sir.
Working very well. Voice speaker volume is also well. What's
Okay,
the
now
problem of breaking
now
it?
I'm able to get you.
Everything is good going. I don't understand why there is a problem of breaking my volume. I think it's all good. It's all good going. I hope it is audible now.
Yes, sir. Yes.
All right. So any income from any vacant land would not be taxable under the head income from house property, because there is no building. As others would be taxable from any other sources or any income that you earn from business or profession. It depends upon the case. Let's talk about in what are the different perspectives to get to know, and to that particular terms will be used in the estimations while calculating the income from house property. So property should not occupied by owner for his own business or profession. It is very important point that in the various questions or theoretical questions it has been mentioned that whether such income would be taxable under income from house property, that whether the owner or the property has should not be occupied. Such property should not be occupied by the owner for its own business. So such property will not be should not be occupied by owner for its own business or professions. These are the 2 points which are very important when it comes to the theoretical purpose. Annual value of house property is not chargeable to tax under income from house property. If the owner uses the building for the purpose of carrying out the business or profession, if the owner is carrying out its own business or any profession on such on under its own properties, that means not taxable, right? Such annual value of house property will not taxable at all. On the other hand, house properties, whatever the owner that have owned the properties and it let out for residential purposes or any other commercial purposes, even if the business of the SSC to own and give houses on rent, the annual value of the property will be taxable under the house property head. I already told you whatever the value, annual value of the property will be taxable if such property has been rented out for commercial or residential purposes. If the annual value of house property will not be taxable if the building is used for carrying out the business for its own purpose, right? If the owner is using such buildings, own building for its own purpose, that property will not be taxable. That annual value of that property will never be taxable. So, if any property that the owner owned and it's let out on rent basis for you can say to carry out for residential purposes or some commercial purposes, such annual value of such properties will be taxable head income. Now, these are the example use of the house properties examples. So you can read if you have any issue, just let me know. Read all the three examples. In these example, it is estimated that whether if such cases arrives or that such income would be taxable or not. So these are the cases. X owns a house property. He uses the property as its office, factory, or godown. As the property is used for the purpose of carrying out his own business or profession. I already told you, if you own the property for its own business, nothing will be taxable. That whatever the income that you earned from your own business on such land, it's not taxable at all. Next category of the example is X Limited is a manufacturing company. The factory of the company is situated in Nagpur. Within the factory campus, there is a residential colony having 50 quarters for workers. These quarters are given to workers for residential purposes. A nominal rent of rupees 100 is charged per month from employees as the purpose. What is the purpose? It's the purpose is let out such property, right? Why X Limited is let out to run the business smoothly. The residential quarters will be treated as house property used by the SSC for the purpose of its business. Nothing is taxable. Nothing will be taxable because such property is let out for its own business or profession. And hence, the Mr. X, any income that earned by let out the property for residential purposes will not be taxable, right?
Yes, I understood.
The third point is why limited makes available few rooms in the factory, in its factory on nominal rent to government for locating a branch of nationalized bank, post office and central excise office for carrying out on its business efficiently, smoothly. If any owner you can say owns a land by let out for its own business, whether it would be build up any nationalized bank or it would be build up any post office banks or any excise central excise offices on such property. But that if you build up such offices for its own business to run smoothly, it means nothing will be taxable because such business, such constructed of its of such of offices will not be taxable because it is for its own business to run smoothly, to run efficiently, and that means no income will be taxable if a owner is let out such land or properties, either residential or commercial, for its own business or to run its own business. Such nothing will be taxable. Let's proceed further. SSC should be owner of the property. As I told you, the second condition from first slide, that the SSC or an individual should be the owner of the property. So these are the 2 points which are very important. Income is chargeable to tax under the head income from house property if the SSC is the owner of the property, or you can say it's deemed as honor. It means a legal right of the owner to use that property. That is called deemed as honor. Next is the owner may be individual, firm, company, cooperative society, or association of persons. It could be anything. I already taught you these things in the first session. The person has been categorized into different types of persons. Either it would be individual, firm, company, cooperative society, or association of person. Would be any one of them. Anyone can become an owner of a property. Next is deemed honor, that is section 27. So deemed honor which have a legal right of the property, he can transfer his property to its spouse or wife. He can also transfer his property or land to the minor child or the major child, right? So if that is also you can see the particular cases, if you see, and that exactly the arise the meaning of the deemed honor. So if we talk about transfer to a spouse, or any individual have a legal right to transfer his own property or house property to his wife other than for adequate consideration, so such transfer is deemed as honor of the company, sorry, property. Exemption, what is exemption? Where a property is transferred to a spouse in connection with an agreement to live. It means such property will be transferred to his spouse if the spouse is residing with her husband or with his husband. Transfer to a minor child, if like individual have a right to transfer his house property to, you can say, his or her minor child, consideration is deemed, right. So let's proceed. This is but just for a reading purpose. You can read and it's easily to understand, right? Just for a theoretical purpose. Let's proceed in typical cases, that these are the points, these are the particular important topics which being asked in the examination and is also equally important for your practical questions which being asked in final exams. I have allowed such student. All right. So, what is composite rent? Composite rent means it's apart from any recovery, a rent of the property. In some cases, if if the owner gets rent from of other assets, or he charges for different services provided like security, any lift services in the building, such amount the amount which has been recovered from such different services is composite rent. And of course it also treated for the calculations of tax under the head income from house property. So if any amount that being recovered from different services like lift, security related to the buildings, related to the such land for used for buildings at the residential or commercial, so any amount which being recovered from such different services, such rent is called composite rent. And such composite rent is treated under the calculation of income from house property. So composite rent is equally split up, where it would include the rent of property, any charges from different services. The rent of property is to be included in income from house property, and other rent of such buildings is included under the income from other sources, or profit from business and or profession. So when the composite rent is rent for letting out of building and letting out of other assets like machinery, plant and furniture, and such lettings are not separable, such income is taxable under the income from business or profession, because such the assets which has been used for the business purposes, either for own businesses mainly, such income, whatever the income earned from such assets, other assets like fixed assets, you can say, the income that has been earned from assets always been taxable under the income from business or profession, because such assets has been used for its own business to increase the value of such business of its own capital, business capital. Next is when the composite rent is rent of letting out of building, assets like plant, machinery, furniture, and such lettings, let outs are separable. You can easily, you can say, segregate such rent from building and of course from as other assets. That means such rent will be considered or taxable under the head income from other sources. So composite rent is the rent that is recovered from the building, that is recovered from the other different services. But it can be classified into two parts. That if the composite rent is letting out of building or letting out from other assets, but are not able to separate. So such income comes from business and profession. And if it is, we can, if the owner can easily segregate, right, easily separate the two different things, that is income, rent from other assets, the rent from, you can see, buildings. So such income will become under the income from other sources, or you can also consider income from business or profession depending upon case. So let's, these are the cases, two cases. If the house property in the foreign country, whether it would be taxable or not taxable. So a resident SSC is taxable under section 22 in respect of a property situated in a foreign country. If it means that any resident who is already an Indian citizen and his property is in foreign country and he's let out for the residential or commercial purposes, and the income which is earned from the property which has been let out in the foreign country, it's equally taxable. It is taxable under section 22. So if you think that I'm not living in a foreign country, I'm living in India, and if I bought a property in the foreign country and let out such property and receive an income from such property, that such income will not be taxable. If you think such, no, it's not true. It is equally taxable if you earn income from such property which let out in foreign country. Next case is when the house property is owned by co-owners. So it doesn't necessary if that you have a property, you own a property, that you are the owner. There might be a different co-owners of the same property. Then what you will do, whether it is taxable or not taxable under the head income from house property. So this is an answer given in the slide. When a house property is owned by co-owners, and what is the section of that? That is section 26. If respective shares of the co-owners are definite and uncertainable, the share of each such person shall be included in his total income, and it may be noted that co-owners are not taxable as an association of persons. It means if such co-owners are considered as an association of persons, it means it is not taxable at all. So, what was the outcome? What was the result of this particular term? So, when we talk about the co-owners, the income earned by the co-owners are not taxable under the section 22, that is income from house property. So these are the two cases. So don't be confused at all. If you have a house property in the foreign country, it is equally taxable, right? If house property is owned by the co-owners, it is not taxable if it is considered as an association of person. If we talk about the individual co-owner, and if any income arises from such land by let out for commercial or residential purposes, then it is taxable, otherwise not. Right? So co-owners is not taxable at all if it is considered as association of persons. So it might be happen in India that co-owners is considered as an association of persons, and it will not be considered or not taxable at all. Now, when income from house, these are the various cases where in such these are cases which are not being taxable at all under section 22. First, farmhouse, it's not in the practice or as well as theoretical question if the term called comes farmhouse and it is taxable or not. So it is not taxable, it is not charged to any of the tax under such head income from house property. If any property held by the charitable purposes like charitable trust, charitable organizations, so such properties will not be, such income from such properties will not be charged any tax. If house property used for own business or profession, which I've already explained in the previous slides, if an owner is using property for its own business or profession, it is not chargeable to any of tax. House property of registered trade unions or local authorities. So if you talk of any house properties with such of the government organizations like local authorities, municipal authorities, we can say any registered trade unions of the workers, it's not chargeable to any of the tax under section 22, which comes under the head income from house property. The next is the it's a palace of ex-ruler or any one palace in occupation of a ex-ruler. If you see that there are so many rurals of India, or you can say kings and queens, and they have a property, huge palaces which has been laid out and comes under the categories of the hotels and the restaurants. So if you talk about that any income which has been earned, it is in that case it is equally taxable. But if in case is any of the palace of rural or any palace in the occupation of any of the ex authorities, such in the name of the ex authorities or ex rural of such palaces, or and on behalf of the ex rural, any income earned, it's not taxable under the section 22 in case of house properties. So now we come to the practical portion, that what are the terms which we used in calculation of income from house property. So this is the particular format. This is a particular format which being used to calculate income from house property. So if multiple choice question has been asked that what are the terms being used in calculating the gross annual value or in calculating the net annual value, then how if we deduct the municipal taxes or add the municipal taxes from the gross annual value. So such question will be asked in the form of multiple choice question. So how would you answer? So you can easily answer if you gone through this slide. So let's begin the format of how to calculate the income from a let out house property. If you own a property and you want to let out such property, so what is the process of calculating the income from let out of such property? So this is a format, that is a gross annual value. What is the annual value of such property? Then you have to deduct the municipal taxes, which is a fixed tax by the local authority. It would be a 10%, it would be or 20%, depending upon the cases. Next, if you deduct the municipal taxes from the gross annual value, you can easily calculate the net annual value. So what is net annual value? The net annual value is the amount which is being calculated by deducting the taxes from the gross annual value of the house property. Next, once you get the net annual value, your next step is to deduct any deductions under section 24. So under section 24 in the salary question, I already told you that standard deduction, it would be 50,000. Here it would be 30,000 or it would be 20% of net annual value, depend upon cases to cases, right? So next one is standard deduction, it would be 30,000. Next is if any of the owner has you can say borrowed some amount of loan or a capital, so that whatever the interest he has paid or she has paid on his house property, that would be come under this heading, that is interest from borrowed capital. And once you deduct these two cases from the net annual value, you will easily get the income from house property. So this format is the overall format when you calculate the income of those properties which already let out, right? Now, see, this is a format. Now, the next slide, the following upcoming slides is how to calculate gross annual value, how to calculate the standard deduction, how to calculate the interest of borrowed capital. So there is a very easy process. If I remind you once and all that how income from house property unit, the chapter, the whole block. It's very easy, it's not at all difficult. The most important is just read the terms, try to understand the terms, which I'm already giving you the notes, of course the slides which are already on your screens. Now we talk about the gross annual value, and there is a little step by step steps, various steps. You can say one by one, various steps, which if you follow, you can say easily, you will easily get the correct values of the income that you calculate from house property. So how to calculate the gross annual value? There is a step one. Find out the reasonable expected rent. So what would be the expected rent, reasonable expected rent of the house property which has been let out? So this is the two terms that you have to remember. First is municipal value or valuation of the property or value of the property, and the second one is fair rent of the property. What are the exact rent of the property on the monthly basis or the annually basis? So if you have in the question these two values is already given, so what is the next point? You need to see which of these two cases A and B points, which one would be the higher value, and that value is taken as expected rent. But always be remember there is one rule, that expected rent should not exceed the standard rent. The standard is standard rent. Standard rent is that rent which has been fixed by the Rent Control Act. As I told that income tax is always believe in acts. So if we talk about standard rent is automatically it's pre-fixed rent which has been done by the Rent Control Act. So standard rent is a maximum rent which a person can legally recover from his tenant under the Rent Control Act, and the landlord cannot legally recover from his tenant more than the standard rent, right? So standard rent and that property, if covered under the Rent Control Act, which I've already told you, it's always there is an act or rule, that is Rent Control Act, and there is a limit which has been decided by such act. So higher of the value of municipal value, that is expected rent, but it should not exceed. For example, the expected rent is 50,000 and the standard limit is 1 lakh. So which value should be taken? The value, that means the expected rent should not exceed the value of 1 lakh. And this condition is not exceed. So 50,000 amount will be considered, right? Suppose if the expected rent is 2 lakh, but the limit of the standard rent is 1 lakh. So what should be the expected rent to be considered is 1 lakh only, because the expected rent should not exceed the standard rent, right? So we will all more clarification when we come to the practical questions. So these are the particular format: municipal value of the property, fair rent of the property, whichever is higher, standard rent, and whichever is lower, C&D, which I already told you that expected rent should not exceed the standard rent. So whichever is lower between the two, that amount will be considered. That is standard rent and expected rent. Any doubts until here, students? It's municipal value of the property, fair rent of the property, whichever is higher, right? That is expected rent. So when you get the expected rent, you need to compare from the standard rent and that standard rent, and whatever the value comes, you can consider the low value when we compare to standard rent. For example, if the you can say expected rent is 1 lakh and standard rent is 2 lakh. So Lower value is 1 lakh. So we consider the 1 lakh value as expected rent when we compare to the standard rent, which is the rule to follow up. Right? If for example the expected rent is 2 lakh, but standard rate limit is 1 lakh. So which value to be taken is a lower value. So 1 lakh, 1 million would be considered as expected rent at the end, right? It's written higher of AB, that is expected rent. Standard rent is already given in the question. So you compare among these two, whichever is lower, that amount will be considered is exactly expected, reasonable expected rent. Now we come to the exact that how to find out the next step. Your first step is already I have explained. The second step is find out the rent actually received or receivable. These steps are actually followed to calculate the gross annual value, right? So the second step is to find out the rent actually received or receivable. So this is a particular format. The rent of the previous year for which the property is available for renting out. So whatever the property is available and you are willing to let out such property in the previous year, and whatever the rent you are receiving from the tenant, that rent amount, either if per month, you need to estimate annually, that means into 12. For example, if the rent received is 1200 per month, so 1200 into 12, right? So it's around 24, you can say 1000, something around approx. Next is you have to deduct any loss due to the vacancy period. Suppose like in a 1 year, 6 month property has been vacant, and after the 6 months such property has been let out. So for the 6 months, whatever the loss has been occurred during such 6 months, that amount would be deducted from the rent. Then again, it would be less unrealized rent if the few conditions are satisfied. Unrealized rent, which the rent which has not been recovered during the particular period. So, so the rent which has not been recovered, that amount has to be deducted from the rent of the previous year. So whatever the amount that you get, that is called the actual rent received or receivable, uh, and that rent is calculated of the previous years, right? So it would be like for the present year is 2023 to 24. So the rent received in the 2022 to 23, that particular rent received in that previous year will be considered in estimating the rent actually received or receivable. So two things has to be deducted, that is the loss due to the vacant period, and the unrealized rent, the rent which has not been recovered during that particular previous year after let out such property. So whatever the amount you have to deduct from the rent, and that amount, the actual amount would be received, that is the actual amount received or receivable. Now, of course, these are the two cases of calculation of gross annual value. So please listen very carefully these two cases, because these two cases is actually being asked in the final examination, whether in the part of the practical question or theoretical. If the actual rent is less than the expected rent, and I already told you that how to calculate the actual rent, which in the previous slide, and how to calculate the expected rent in the step one, right? So due to the loss of vacancy, that the property is let out, and it's before letting out the property is already you can say vacant, and it's not being used. So whatever the loss has been occurred in that case, If the actual rent is less than the expected rent, then it means gross annual value is the actual rent. Second case, if the actual rent is less than the expected rent because of the loss due to the vacancy and other factors, that is unrealized rent, the rent which has not been recovered during that particular period and the loss due to the vacant period. So if because of these factors, including other factors, due loss due to vacancy, that means the gross annual value is equal to expected rent minus loss due to vacancy period. Right? So it is a very important to note down. If the actual rent is less than you have to compare to calculate the gross annual value due to such cases if given in the theoretical question or practical question. If the actual rent is less than the expected rent due to the loss of vacancy, any loss incurred in it, right? That means gross annual value is actual rent only. If the actual rent is less than the expected rent because of the loss of vacancy and other including other factors as well, that is unrealized rent, it means gross annual value is a expected rent minus loss due to such vacancy period. For identification of cases, find out the difference between the actual expected rent and actual rent received. If such differences is higher than the loss due to the vacancy, if you have to calculate the difference between the two, rent actual and expected amount rent received, and if such differences value is higher than the value of a loss of vacancy, then you need to apply case second. That means the actual rent including the other factors as well. So if the difference is equal or less than, then the case one is applicable, right? That means you simply say the gross annual value is the actual rent only. If due to if the difference between the actual rent and expected rent is equal or less than the value, you can see the loss of the value. It means gross annual value is the actual rent only. So these two cases are very important because these two cases, the question has been asked in the practical questions and the multiple choice questions as well. Right? Now we talk about here again the similar pattern, the case third and case fourth. Actual rent is less than the expected rent due to the then and gross annual value is equal to the expected rent. And case fourth, if actual rent is more than the expected rent, then also the gross annual value is also equal to the actual rent. So these are the four cases where you need to remember or you need to understand the concept actually. So if such of the cases has been given in the question form and multiple choice and option has been given, so you can easily identify the correct answer. So maximum, if it is actual rent is less than the expected rent and due to the loss of a vacancy, due to loss of vacancies period, then gross annual value is equal to the actual rent. Right, so these are the notes given for you. So just go on through these notes. It's very easy for your. You can say that what are if the tenant pay the rent, what exactly amounts or deposits or charges or commission paid included or not while calculating the income from house property. So these are the notes given for you. So just go on through once after wind up the sessions when I share you the slides. These are also the notes. So let's go on through the notes. If the tenant has undertaken to bear the cost of repairs, the amount spent by the tenant cannot be added to rent received or receivable. So if the tenant has took a responsibility to bear up all the cost of the repairs. So whatever the amount spent by the tenant will not added at all in any of the rent received or receivable. A non-refundable deposit will be included in rent received or receivable on pro rata basis. Pro rata basis means 30% would be received and rest person will not be received. Right, the next one is it's refundable can amount deposit cannot be included at all in the rent received or receivable. Advance rent cannot be a rent received or receivable of the year of the receipt. So whatever the rent received in advance cannot be considered in the rent received or receivable. Commission paid by the owner of a property or to a broker is not deductible from rental income. Maintenance charges are not included in any of the rent received or you can say receivable. Commission, whatever the commission paid by the owner of a property to a broker is not deductible for any of the rent received. So these are the following points. So you just know about it, what whether these particular items will be included in the rent received or receivable or not. Next is under section 23 and subsection 5, where the house property is held at stock in trade, and if it is not let during the whole or any part of the previous year, the annual value of such property or any half of the property shall be taken as nil. So if any of the house property has been taken on as for the purpose of stock in trade, right, or during of the previous of any of the previous years, so always be remember the annual value should be of such property will be considered as nil. Don't take any of the amount given in the question. So always be remember students are being confused in these particular cases that whether the amount would be considered or as taxable or not. So the answer is it's nil. No annual value, no value would be considered as annual value in such cases if the house property has been considered in stock in trade. Next, this concession is available. Now the question is any fees concession, any rent concession only for a period up to 2 years from the end of the financial year in which the certificate of completion of construction of the property is obtained from the competent authority. Always be remember if you have owned a property, have purchased a property and you are now trying to construct that property to let out such property for residential or commercial purposes. So always be remember concession is available up to the 2 years. It means you need to finish your construction in 2 years only. That means on that case only you will receive a concession from the competent authorities. Right, it has always been given in the question. If any of the question is already given that the house has been purchased and is in the constructing is the construction process will be completed in this particular year. So while calculating when you have purchased a property till the construction of the property, if it is 2 years, within the 2 years or 2 years the owner has completed its construction, then the concession is to be granted by the competent authority. The fees concession is to be granted by the competent authority if it is the construction has not been completed and took above 2 years. If the house property has been constructed and took above 2 years, no concession will be given to him or her. Next, that what items is need to be excluded from unrealized rent. right? So these are the items which are no need to include in unrealized rent or while calculating the unrealized rent. There are various varieties of questions where the terms has been used so differently, but the meaning is exactly the same, because the meaning is automatically depends on the rules which has been taught to you during these slides, and these rules are same in any of the country. Whether you go to US, you do a job or income tax officer or income tax assessor, the rules are same. There is no changes in the rules, right? So it is very important to understand it which items to be included in such particular unrealized rent or not. So these are the items. It is the rent which the owner could not realize. So any rent the owner couldn't realize, so such rent will not be, you can say, exclude or not. It depends upon the condition which needs to be satisfied. So these are the 4 points. The tenancy is bona fide. The tenancy period should be legalized. So if you are giving your property to let out for commercial to a tenant, there should be a proper legal agreement of that particular years. It would be 1 year, it would be 2 years, it would be 3 years. The minimum 3 years legal agreement should be there, right? Next, the defaulting tenant has vacated or steps have been taken to compel him to vacate the property. So if any of the defaulting tenant which has not been paid the rent in the last couple of months, and you want to vacate that property, so the rent which you have received, it cannot be included, and you can say it's termed as unrealized rent, because the rent that you have not received in the last couple of months, and that tenant, it comes under defaulting tenant, so such amount will not be included at all. Next is the defaulting tenant is not in occupation of any other property of the SSC. So the defaulting tenant is not in the occupation list which being included or which being listed in the owner's, you can say in the owner's hands, right? So whatever the property, the defaulting tenant is, if the defaulting tenant is not in the occupation list of any other properties of the SSC, so that not such amount will not be included in unrealized rent. The SSC has taken all legal steps to institute legal proceedings for the recovery of the unpaid rent or satisfy the SSC officer that a legal proceeding would be useless. So that also being that any of the legal process to be proceed or to be taken against a defaulting tenant. So whatever the amount we need which has not been, you can say, or which has not been received or unrealized, so such amount will not be included under unrealized rent. So these are the particular category. If you talk about any defaulting tenant, will not included in unrealized. Just remember, in a very simple terms, I'm just explaining. If you found any defaulting tenant, and in case of the rent received or not, such defaulting tenant will not be included under unrealized rent. Now we talk about the municipal taxes or the taxes levied by any local authority. So these are the particular taxes. These are deductible. As I told you that municipal taxes always been deductible from the gross annual value only. And these taxes are borne by the owner. That means owner has to pay such taxes, and actually paid by the owner during the previous year. So whatever, and it is actually paid by the owner of during the previous year. So whatever the taxes is being paid is all for the during the or during the previous year of the previous years. These are the notes given over here. In other words, municipal taxes due but not paid, that is outstanding, shall not be allowed as deductible. right? So the taxes which has not been paid, how the particular assessor would allow you to deduct such taxes from your gross annual value of the house property. Next, municipal taxes paid during the previous year are allowable as deduction even if they relate to past years or future years. So definitely whatever the municipal taxes that you pay during all the previous year, they're equally taxable, equally deductible from your gross annual value, right? Even when the property is located outside India, it is a very important point. Even when the property is located outside India, taxes imposed by local authority in that country are deductible while calculating the annual value of the property, right? So always be remember, keep that means that if the India is always have a right to deduct the taxes, if the property is an outside country, the outside country competent authority has a right to deduct the taxes from the while calculating the annual value or gross annual value of the property. And the same rule is being followed in India as well. Deductions under 24, as I already told you that once you deduct the municipal taxes from the gross annual value, you will get the net annual value. And once you get the net annual value, you need to deduct or you need to deduct the deductions under section 24. So these are the two deduction, that is standard deduction. And what is the standard deduction to be? Is the 30% of net annual value is to be deductible as the standard deduction. As I already told, in the salary part, the standard deduction is 50,000. But in this income from house property, the standard deduction is 30% of net annual value. So whatever the value has been calculated as net annual value, standard deduction is to consider the 30% of the net annual value, and that's called standard deduction. Next one is interest on borrowed capital. So interest on borrowed capital is allowable as deduction if the capital is borrowed for the purpose of purchase. Remember these things, this small points, because very important to answer correctly in multiple choice questions. So if the capital is borrowed for the purpose, on what purposes? For the purpose of purchase, construction, repair, renewal, or reconstruction of the property. It means the interest will be chargeable on such borrowed capital for these purposes. So it is equally deductible from it is equally deductible under section 24. Now, interest on borrowed capital, these are the following notes to be followed once you will understand the interest on borrowed capital. It is deductible on accrual basis, like the interest rates, it fluctuates on every year, right? So accordingly, that interest rate is need to be considered to estimate such value, borrowed interest value. It is claimed on yearly basis, even if the interest is not actually paid during the year. It is very understood. So I don't need to explain these you can see points. It is available even if neither the principal value nor the interest is a charge on property. Interest on unpaid interest is not deductible. So the interest which is not paid and you are charging in the bank is charging interest on such capital is not deductible at all. Deductions for okay commission is always been important. Okay, you got a particular you can see broker has received the commission, and on that basis the commission would also include in the rent, or it should be deductible or should be taxable under the head from income from house property, or deductible under the deductions under section 24? So the answer is no. Would be allowed on the brokerage or commission received by the broker or the mediator of that house property, right? Interest on the fresh loan taken to repay the original loan raised, but for the unforeseen purposes, it is allowable on deduction. Of course, it is deductible. If a fresh loan is repaid, the original loans rights by a competent authority, or you can say for any of the purposes, definitely on such conditions, such cases, deductions is applicable, or deductions and of course is allowable on such cases. In case of let out property, there is no maximum ceiling of deduction. So always we say that there is no maximum limit of putting up deduction amounts, or putting up, or you can say exact maximum limit that okay, 5 lakh rupees would be chargeable as deduction if they let out the property. No, there is always a fixed limit that is 30% only. So 30% in every cases, whether it's be let out or occupied, self-occupied properties. So it always be 30% only, and beyond such limit, beyond 30%, it not being deductible under section 24. Interest on pre-construction period. So pre-construction period, then how to calculate the interest on pre-construction. The construction is going to begin, and before that you need to estimate your interest on such property that you have purchased for the purpose of letting out. So pre-construction period is the period commencing on the date of borrowing and ending on 31st March, immediately prior to the date of the completion of construction and date of acquisition. So automatically till the completion of construction period, the interest will be chargeable on each month till the finishing period of your construction of the property. Next, or date of repayment of loan, or you can consider either the ending month of the financial year, your ending date, or the date of repayment of the loan, the date that the owner has decided on this date, I will repay the loan. So that date will also be considered, and this date will be given in your questions, practical question. So when we talk about these two dates, either March 31st or any date on which you have willing or you want to repay the loan, whichever is earlier, it is March 31 or below March 31. So whichever the date is earlier, that date will be considered as a pre-construction period. So whichever is earlier, it is available in 5 equal installments in the 5 successive financial year. If you take a loan of 5 lakh rupees, that 5 lakhs will be divided into 5 equal installment. That is 1 lakh, 1 million, 1 million, 1 million. The five installments. A particular owner has to pay 1 million in each in 5 successive financial years. So in every year, the particular you can see candidate has particular owner has to pay 1 lakh in each year till the completion or till the finishing of the construction period, right? So it is always been stated in 5 equal installment. If the owner has not been paid within the 5 years, in the 5 equal installment, the double interest will be charged on that particular principal amount of the loan. So this is a particular, you can say, the format, the rules that you need to follow up in theoretical purposes and of course in practical. House property, which is a part of the year let and part of the year occupied for own residence. So in this case, period of occupation of property or for own residence shall be the irrelevant and annual value of such house property shall be determined. So it depends on which period is being let out. So on that particular date will be considered, or that is the period of the occupancy of the occupied of property for own residence. The expected rent shall be taken for full year, and but the actual rent received or receivable shall be taken only for the period let. So expected rent has always been on annual basis, but actual rent is always being calculated on the periodically. Other provisions will remain the same. Every rule is always be the same. There is no changes. So when we talk about occupied for own residence, so these 2 points should be considered, that the period of occupancy for own residence shall be, that period will be considered, whether it would be the previous year, it would be the current year of the whole, it will be considered the same dates, and such dates will be also given in the questions, so there's no need to worry at all. Expected rent will annually basis, actual rent, whatever the actual rent on the further will be considered only the period that on that particular period in which it is such property is being let out. So if the let out period is 2 years, so 2 years, the you can see actual rent, whatever the actual rent received or receivable, that amount will be considered for 2 years. Now, this is whatever I taught you in the previous slides is it's a case of let out property. Now, in this particular slide is a self-occupied property. That means the property occupied for your own residence, for your own purpose of residing. So this is a particular, you can say rules. It's a very easy rules. There is no, you can say difficulty to learn the concept. Once you read, you can easily understood. If the SSC owns and occupies only one house property for own residential purposes, self-occupied. So, if this is the case, it is treated as self-occupied property. If you have owned five lands, and in five lands you constructed a building in the 4 floors, and one floor you have occupied for your own residence. So definitely it is a self-occupied property because you are occupied such floor or particular flat for your own residence, right? Next point, if two house properties are used by owner for its own residential purposes, so both are treated as self-occupied property. If the property are used by the owner for his own residential purposes, so definitely the self-occupied properties. If more than two properties are used for own residence purposes, so if the two properties is used by the owner, both properties are treated as self-occupied. If more than two, let's say three, only two properties will be treated as self-occupied and rest will be treated as deemed to be let out property. Deemed to be let out property means that property, the particular individual or has owned the property for making a legal transaction, but that property it's not actually, that person is not actually the legal owner. So that is called a deemed to be let out property. So this is a particular format, and self-occupied calculation of calculating the income from house property is far easier than the let out cases. So let's talk about the net annual value. So in the let out property, we need to calculate the gross annual value, then net annual value. But here we need only net annual value, so which is all being given for the in the question. So if you talk about net annual value, it's nil. No amount will be chargeable because that property is used for self-occupied or for own residence. So there will be no amount or no rent will be chargeable. And directly you will deduct under, you will have to make the deductions. You have to make the deductions under section 24, and the same particular procedure that you need to follow up: standard deduction, interest on borrowed capital. Then once you deduct these 2 points, two items from the net annual value, you will get the income from house property. So if we talk about that, when we talk about self occupied cases, so net annual value, you will no need to take any value, it's nil. If we talk about standard deviation is nil. In case any interest has been incurred on the borrowed capital, that interest amount will be calculated. So that value, and of course that value will be considered as income from house property, and it will be negative also, it will be positive also. So it would be anything would become. So interest on borrowed capital. So that in that case, note one. So this is an explanation in self-occupied here. So if the following condition are satisfied, interest borrowed capital is deductible up to 2 million. In India, we say 2 lakhs, but in foreign country, we say 2 million. Right? Capital is borrowed on after, if the capital is borrowed on and after 1999 for acquiring on construction of property, so interest will be chargeable. If any of the acquisition or construction should be completed within the 5 years from from the end of the financial year in which the capital was borrowed, that is also interest would be chargeable. In that basis, if these conditions, these are the three conditions, if three condition has been fulfilled, right, that means interest capital will be chargeable up to 2 million only. There is an interest certificate available for the interest payable on the loan. Maximum amount deductible is rupees 30,000. The following on the basis of two cases. If the capital is borrowed for any other purposes like reconstruction, repairs, or renewal of the house property, if one or more of the above condition are not satisfied. If these three conditions are not satisfied and only the one condition is satisfied, the capital is borrowed for other purposes like construction, then 30,000 would be deductible and 30,000 would be considered as interest on borrowed capital. If the three condition has been satisfied, then the interest on capital, interest on borrowed capital will be charged up to 2 million only. So this is the rules actually which you have to follow up. Next is a house property which is not actually occupied by the owner owing to employment or business or profession carried on at any other place. So like the house property which is not occupied for self purpose but occupied for their own business profession which has been carried out at any other place. So these are the particular following points that need to be considered. The taxpayer owns one or two house property which cannot be actually occupied by the owner owing to employ and carried on any other purposes. So whatever the tax would be chargeable, the owner has to pay off. He has to reside at any other place in the building not owned by him. If such cases like for the business, profession, employment, it means the owner has to reside at any other place in the building which he has not owned actually. The property or properties are not let out during whole or any part of the previous year. No other benefit is derived from above property or properties by the owner. So owner doesn't receive any benefits. Owner doesn't let out such property. Owner has to reside in any other place in the building, but not in the exact building. So the taxpayers, whatever the tax owner pay owns one or two house property is not actually occupied by the owner. just for the purpose of employment, business or profession, or carried out any other place. So if the above conditions are satisfied, income from house property shall be determined according to the SOP, that means self-occupied properties. That is case 1. Right? This is which I'm telling you. This is the case 1, case 2, case 3. Case 1, case 2, case 3. In the case 1, if three condition has been satisfied, these condition, this above condition, these four condition is being satisfied, that means income will be considered, will be taxable under such cases. When the part of the property is self-occupied, like you own a property, you have constructed a building on that property, now there is a process to let out. Let some part of the property you have self-occupied and the other part of the property you have let out. So how you will identify, how you will estimate the income from such property? So let's begin. So you need to calculate the income from house property separately, because let out cases rules are different and self occupied rules are different. So you need to estimate the income from house property separately. So I already told you, when we talk about let out cases, the same rules to be followed. And when we talk about self-occupied, I already told the rules or the format, the same format and same rules is need to be followed. So you need to calculate separately for each unit. Unit self-occupied for residential purposes throughout the previous year. That I already told you. You can see self-occupied property case 1. House property which are not occupied, owned to business or profession or carried out any other purpose, that is case 2. Let out units, that is let out units, unit treatments, whatever the rules and regulations were let out, you need to follow. That is gross annual value less the net annual value deductions. The rules of the standard deduction borrowed is different, so which I've already told you in the earlier slides. Notes is already given. Municipal value or a fair rent, if not given separately, shall be a portion, shall be, you can say, segregated accordingly between the let out portion and self-occupied portion on the build-up area basis. So how much the build-up area is, accordingly we'll calculate the, segregate the amount between the you can say let out portion and self-occupied portion. Municipal taxes and interest shall be a portion of the build-up area or full area wise area space. So whatever the segregation of the amount between the let out property and the self-occupied is basis on the floor space area, is basis on the build-up area. So when we talk about build-up areas, so we talk about the municipal value and the or fair rent. If we talk about the taxes and interest, it always you can see area space, right? And it is a build-up area space. So the both terms are different, floor space area and of course the build up area space. But in the first, only the build up area space, not floor area space. So this is the difference between the two. So when the house is self-occupied for a part of the year and let out for the remaining part of the year, let's say 6 months is a self-occupied and the rest 6 months is let out. So the income will be calculated as the properties let out. So in case of let out, the income will be calculated, but in case of self-occupied, no income will be calculated. Right, so this is the main confusion here. Okay, the house is self-occupied for 6 months, part of the year, like for 1 year, and the remaining years would be the let out. Like for example, there is a 5 years agreement with the tenant. 1 year is self-occupied, and the 4 years remaining years will be the let out. So for the 4 remaining years, let out calculations will be considered, and for the self-occupied for the 1 year, no calculations will be needed to estimate, right? Now, any interest when not deductible, so any interest which is not deductible for income, this is a particular point. So, any interest chargeable under this act which is payable outside India. So, any interest which is payable outside India shall not be deducted if these two case, if two condition has been incurred. Tax has not been paid or deducted from such interest. There is no person in India who may be treated as an agent under section 163. So here, any agent will not be considered. No tax being paid or deducted from such interest. So whatever the interest you are paid, if no interest is deducted or charged, that means such interest will not be deductible under income from house property under section 25. Any areas of rent or unrealized rent received subsequently, it's taxable in the year when the actual rent realized in the previous year or for the financial year. Deduction is always been the same, that is 30% of the rent received or realized available. Taxation, even if the assessee is not the owner of the property in the financial year of the receipt or realization. So when we talk about any areas, even if the owner is not, even the owner is not the actual owner of the property in the financial year, then also it is taxable. If there is any areas of rent or unrealized rent receipts in the subsequent years. So this is a property owned by the co-owners. So these are the particular, you can say, a summary we can say over in this particular table. Self-occupied property is an annual value of the property of each co-owner will be nil. See, I already told you when we come to the co-owners, there is no taxable, there is no tax will be chargeable, and the same I always stated in during the whole session in self-occupied property, even if the owner or the association of persons, and of course if for the co-owners also no tax will be deductible, right? It means it's nil. Each co-owner shall be entitled, but he has to have a deductions, that is 30,000 or 2 million as the case may be, any interest account, interest on borrowed capital, which I already taught you in the earlier slides. However, if the co-owner owns another self-occupied property, the aggregate interest from the co-owned property and the other self occupied property cannot exceed 30,000 or 2 lakhs, the case as the case may be. If any of the co-owner, whether he earn more or self-occupied property, it doesn't matter at all. No tax will be deductible, only the deductions and the interest on borrowed capital will be considered. Deduction would be nil. Only the interest on borrowed capital would be 30 or 2, whichever is earlier available. Now, in case of the let out property, as already told you, everything is need to be calculated. The income from such house property in case of let out shall be calculated if the property is owned by one owner and and thereafter the income so calculated shall be segregated or apportioned almost each co-owner as per the specific share. So in the question, if it is already mentioned the share of the co-owner, and accordingly that share is to be considered and accordingly calculate the value of the co-owner. So always be sure, can the net annual value be negative? Always have a question in the multiple choice. It should be negative or positive. Most of the students, or like half portion of the students, it says like, oh, it could be, it could not be, but not a final answer. But the final answer is yes, it could be. Because what was the reason behind it? It's always the reason about the taxes. Municipal taxes is always been the high rates it's 30, it's always be decided by the you can say control tax authorities or competent authorities. So it would be higher taxes to be charged. So if suppose the gross annual value is less than the taxes, so definitely the net annual value comes negative. So always yes, when the municipal taxes, the reason behind it, when the municipal taxes paid by the owner are more than the gross annual value, which I've already taught you. Can there be a loss under the head of house property income? This is a very important question. That's true. It could be, it could not be, but it depends upon cases to cases. I cannot say that any income calculated from house property, it could be a loss or it could not be a loss, but it depends on the cases, right? So if we talk about in self-occupied cases, yes, it could be a loss. Why? Because it could be a loss. Why? Has been proved in the format. When we talk about self-occupied, say this is a self-occupied. So if you see self-occupied here, so you can see the income from house property is in negative because only the interest has been deductible. So if it interest will always be negative because interest is always be your deductions, right? It is in minus because if we deduct only the deduction part to be mentioned, those the income of house property is it is in loss. So that's why it if in case of self-occupied, it would be a loss. In other cases, loss can be there because of the municipal taxes as well as deduction. As I already told you, if the net annual value is negative, so definitely the income from house property is also be negative. Why? Because the deductions, because after calculating the net annual value, if the net annual value is in negative, the deduction is also comes in negative, and at the end of the result will be negative. So that's absolutely true. The loss always be the loss, not always. It depends upon cases to cases, which I've already mentioned in the slides. Deductions under 24 can be more than the net annual value, and as a result, it become a loss under the income, under the head house in house property income or income from house property. So this is the end of the theory part of this unit of this block, that is income from house property. Right. So now we will begin. You can see some of the little practical question by today only. Just wait. Just wait for 1 minute. Let me open practical questions file. Yes. Let's open window. Oops, it's not sharing. I'll repeat once again. Open window. Yes, it's come now. Oops, what's the problem? I repeat again. Window. Yeah, great. What's the problem? Just wait for 1 minute more. I hope it works. All right. Now, this is I already taught you income from house property, which is in yellow portion. This is the exact format which I already taught you, right? Now, income from house property is already taught. These are the basic rules. Now we come to the questions. So this is the same format which I've already taught you in the last slides. Is the same format in this. Gross annual value, 2 points, municipal rental value, fair rental value, whichever is higher. So once you get the higher value, right, that is reasonable expected rent. So you need to compare that with the standard rent. So whichever is lower, that is the expected rental value, right? That is the reasonable expected rent, in other words. So it's step three, expected rental value and actual rent value, whichever is more. If whichever is more, then more is value is GAV. So whichever is more, for example, expected rental value and actual rental value, whichever is more is a gross annual value. So let's start the numerical questions now, right? From the figures given below, calculate the expected rental value. But how to calculate the expected rental value? This is the expected rental value. If you look it up. Step one, step two. So let's apply step one. Municipal rental value and fair rental value, whichever is highest to be considered. So in the question, municipal rental value and fair rental value and standard rent. So while calculating the expected rental value or reasonable expected rent, these three items must be available. And if it is not available, if the standard rent is not available, then also the expected reasonable rent can be calculated, right? See, in the case one, the standard rent is not given, but then also we can able to calculate as the case may be. So let's begin of case A. Case A, case B, case C. We have two items we need to compare. Municipal rental value and fair rental value. Municipal rental value and fair rental value is given, right? So let's A1. Municipal rental value and fair rent value is case A is 30,000 and 36,000 in case A. 30,000 and fair rent is 36,000. What is the rule? You need to find out which is the higher value among these two items. Municipal rental value and fair rental value. Higher is fair rent value, that is 36,000, right? Standard rent is not given. It's not applicable under case A. So, as per the rule, whichever the higher value, you need to compare with the standard rent, right? So, whichever is lower, that value is called the expected rent. But standard rent is not given, so we need to compare 36,000 and standard rent is not given. So the whatever the higher value is, whatever the value is comes under higher, it's the same value will be considered as an expected rent, right? If the standard rent is not given, if the standard rent is not, if the standard rent is given, so whichever is lower value after comparing from the standard rent, that value is the expected rent. So let's talk about case B and case C. Case B is a municipal values 30,000, 36,000, and 33,000. B 30,000, case B 30,000 and 36,000, whichever higher is 36. Standard rent is given in case B 33,000. So 33,000 is the standard rent. Whichever is lower is expected rent. So what is a lower amount? 33,000 is a lower amount. So 33,000 is a ERV, expected rental value, or in other words, it's reasonable expected rent. In case B also, its municipal rental value is 36,000 is a fair rent, whichever is higher is 36,000. Standard rent is given in the quotient 42,000 and standard rent is 42,000 in case C. Whichever is lower is expected rent. So lower is 36,000 in case C. So 36,000 is the expected rent. So this is a way to follow up the rules in the practical question theoretically. Any doubts in this, students? Any doubt in this question? It's very easy, it's not at all difficult.
No doubt, sir.
Okay. So if you have any doubts, please let me know. So this is a question, more questions has been given. So you need to do at your home. You need to calculate the expected rental value, case A, case B, and case C. Right? So you need to calculate the values here in the sum in the same similar way. This is also the another question. It's already given to you, and the same procedure has to follow up, right? So you can apply what you can easily do. Calculate the annual rental value. Now this is a different question, one by one. You have even the municipal rental value is also given, fair rental value is also given, standard rent is also given, actual rent is also given, right? So you need to calculate the annual rental value. Annual rental value is just being given here. So MRV is already given, whichever is higher, standard rent, whichever is lower. If the actual rent is given, so whichever is higher is the annual rental value. So once you will get the lower after comparing with the expected rent. So this is ERV. So when you compare the expected rental value with the actual rent, and whichever is higher is the actual annual rental value. That is 72 and 66,000, right? So this is how you need to calculate annual rental value. This is also the another case given to you, right? Annual rental value. What is the other meaning is called? It's another words we call gross annual value. So actual rental value, in other words, we call gross annual value. So one name has different names. So don't be confused at all, right? So whichever is higher, expected rent and actual rent, whichever is higher is the annual rental value or annual gross value, right? So this is also another practice question. Gross annual value, you need these four items. Whichever is higher is a gross annual value. We can be, in other words, because an annual rental value or gross annual value is the same, right? This is also another question. Just follow up and actually you can write. See, we talk about the actual rent. In other words, we also call the real rent. Real rent and or actual rents is the same meaning, same meaning, different words. So don't be confused, right? So same procedure you need to follow up, and in the next session we will proceed in the further numerical questions. So these are the expenses now. So this is a question given to you, and now in this question there is a different. Now in this question the expenses has been also given, that is lift maintenance. I already taught you that is the different services like lift, securities services. So these are the services or maintenance expenses has been incurred in this question. You need to calculate the annual rental value of the property. It means gross annual value of the property. And this is a question given to you. Mr. Prakash has constructed a multi-story building at Delhi consisting of 40 flats is let out at the rate 1,000 per month. PM stands for per month. The municipal authorities have fixed the rental value of this property as 4,50,000. So the rent value is already given in the question. The owners bears the following expenses: lift, pump maintenance, salary, watchman and swimming pool expenses. You need to calculate the annual rental value of the property. So this is a procedure that you have to follow up. Municipal rental value 4,50,000 and actual rent. In the question there is not given any standard rent, there is not given any you can say expected rent, no rent has been given, so that means these terms will not be used in the question, right? So directly you can easily come municipal rental value and actual rent, because the actual rent is a real rent. As I already told you that you need to find the actual real rent, you need to compare with it, but there is no other items has been given to compare. So you can directly use that terms in the question to find out the annual rental value or gross annual value. So municipal rental value is 4,50,000. Annual actual rent. Actual rent is how much? 40 flats into 1,000 into 12. 40 flats into 1,000 into 12. 40 flats rent amount is 1,000. So 40 into 1,000. It becomes, you can say 40,000 into 12 months. So 4,80,000, right? 4,080,000. It's the amount has been calculated as actual rent. Whatever the expenses to be deducted from the actual rent, whatever actual rent means or real rent is the rent that you have received during the tenancy period. So this is expenses which need to be deducted from the actual rent only. So whatever the amount comes is 4,47,400. Now whichever I already told you that if you need to calculate the annual rental value, gross annual value, it should be higher of both. Only the both two items has been given in the question. It's rent, municipal rental value and annual rent, whichever is higher is a gross annual value. So it's already given 4,50,000 and it's a rental value municipal, and the actual rent is 4,47,400. So whichever is higher is a gross annual value. That is 4,50,000 is a gross annual value. So always be remember that whatever the rule says you need to follow up, but it does not necessarily say the items which is given in the rules is the same items value, the same terms or you can say item values, you can say always been given in the question, it does not necessarily. So accordingly you have to estimate and follow up the rules. If you need to calculate the gross annual value, whatever the values has been given, estimate the values, and whichever is higher out of these two, it's a gross annual value. It's very simple, right? So that's it for today, students. So I like just practice, and I will share you the theoretical notes of house property. So once you've gone through, so that you can easily practice these questions, I will also share once I will finish these questions more in detail in the next session. And once I finish, then I will start a new block in the next session only, right? That is being income from business or profession, right? Any doubts in this session today?
No doubt, sir.
All right, we wind up the session of for today here only. And in the upcoming session, we will learn a new particular new topics, new varieties of question in the same chapter, that is income from house property. So let's just have a look of more questions. So this is also another question. Expenses has been given. This is how you have to estimate. This is also another question. And the solution has also been given so that you don't face any problem. If you know the concept and rules, you can easily do these questions. There is no problem in that. So see, these four values has been given. You need to calculate annual rent value, same rules to be applied, right? See, the loss due to the vacancy, the theoretical concept, the rules is already on that particular theory notes. So you have to apply the same thing. Values is already given due to the loss in the question. So this is a way that how you solve these questions. So one by one, I will try to sort out and explain all the varieties of question by the next session, and I try to begin a new block from the from on next session shortly, right? So that's it for today, and we will begin the new varieties of questions and new topics on the next session, upcoming session. So till then, take care and just go on through whatever I taught you today. So if you have any doubts, put up that query in the group. I am ready to sort it out. Right? Take care and goodbye to all.
All right, so thank you. Goodbye.
Bye. Bye to all. Take care. Bye. Bye.
Someone